17-year-old driver in Minnesota is about to cost their parents 4 to $6,000 a year in car insurance. That's not an exaggeration. That's what the actuarial tables show. The question isn't whether it's expensive, it is. The question is whether you know the one decision that cuts that number nearly in half. By the time this video is done, you'll know exactly why young drivers cost so much. And more importantly, the specific moves that actually lower those rates without lying to your insurance company. Insurance companies don't charge more because they're mean. They charge more because the data is irrefutable. Drivers aged 16 to 19 crash more often and more severely than any other age group. In Minnesota specifically, you've got long, harsh winters where ice and snow make inexperience especially dangerous. You've got higher vehicle theft in parts of the Twin Cities metro. You've got heavy traffic that increases how often that young driver is actually behind the wheel. Insurance pricing is pure math based on millions of actual claims. The carriers look at that data and price accordingly. Here's the move that saves most families the most money. Keep your teen on your household policy instead of buying them their own. When a 17-year-old is added to a parent's existing policy, the cost is typically $1,400 to $2,000 a year. When that same kid gets their own standalone policy, it's $4,500 to $6,500. I see this every single week in my agency. The difference is your existing policy already has loyalty discounts, multi-vehicle discounts, bundle discounts. The young driver is just an increment to that. A new policy for them starts from zero. If your young driver goes to college more than 100 miles away and doesn't bring a car, you're leaving money on the table if you don't ask about the student away from home discount. Most carriers will cut the young driver surcharge by 30 to 40% because they're only driving during breaks, not every day. That's real money. Clients ask me about this all the time, and most of them never heard about it. The number one thing I see families get wrong is trying to save money by splitting the young driver onto their own policy at age 20 or 21. Parents think they're protecting themselves. What actually happens is that standalone policy costs more than staying on the household plan, and you've gained nothing. Your kid is still a young driver with limited history. You should stay together until they move to their own place or their record stabilizes. That's usually mid-20s or later. Right now, call us at 7637-3374-75. We're American Family Insurance, licensed in Minnesota,